Welcome to the show. Interest rates are down, housing sales are up, unemployment is up, the Dow is down. Are you confused about all the ups and downs in the economy and what it all means to you? My guest today has some answers and some predictions of what may happen here in the near future. Peter Schiff is a stockbroker and analyst and is president of the brokerage firm Euro-Pacific Capital. Thanks for joining us.
Thanks for having me.
This morning. You know, there's been a lot of confusion. I think we were all happy for a while. Tech stocks were doing really well. Housing prices are up. Interest rates are down. September 11th came along, and we've had kind of nothing but bad news ever since. Is this expected? Is this what's going to happen? What's going on?
Well, I think the news is going to get a lot worse. I mean, first of all, when you said that tech stocks were doing well, the stocks were doing well, but the companies were never doing well. You know, a lot of the earnings were being manufactured. You know, a lot of the executives of the tech companies are compensated through stock options, and therefore their incentive is to do whatever they can to get the short-term price of the stock up so that they can sell their options and make money. It doesn't matter if what they're doing is sacrificing the long-term solvency of the company. They don't care about the long-term solvency because they're selling in the short run. So rising prices only benefit you if you're going to be a seller. But as a long-term investor, you've got to look at the fundamentals of the company. You've got to look at the dividend yields. You know, that's how you make your return. I mean, what a stock is, the way you value a stock, it's the present value of its future dividend streams. And most people today who are buying stocks don't even look at dividends. And most companies aren't paying them, which is one of the reasons that they can get away with faking their earnings. Because if you don't have to pay a dividend, you can pretend you're making money. Just like the reason that Enron was able to pretend they had earnings is because they didn't have to write a check. You can't send out a pro forma dividend check that says, you know, this is the money that we could have paid you out in dividends, right. You know, but don't cash it. You know, so the market is still extremely overvalued, and don't believe the propaganda, and that's what it is. When you're listening to an analyst on a lot of these popular financial shows, or the mainstream Wall Street firms, you're not getting investment advice. You're getting propaganda. These firms are trying to sell you stocks. Their real clients, their banking clients, are trying to get rid of stock. And they hire these Wall Street firms to peddle their merchandise, and they want to get as much as they can for these overvalued stocks. So you're not getting unbiased advice by the media. We are in the early stages of a bear market. This bear market is going to last for a long time. We were in a bull market from 1982 to 2000. Mm-hmm. Bear market began in 2000. It's probably going to last another 5 to 10 years. I think the bulk of the downside is going to happen in the next couple of years. Then we'll probably trade sideways for a while, but inflation will be very substantial. Just like people forget, we had a terrible bear market in the 1970s. The market peaked, the Dow Jones peaked in 1966 at 1,000. It then went down to about 600 in 1974. It didn't get back above 1,000 until 1982. So from 66 to 82, you were at 1,000. Meanwhile, inflation was tremendous during that period. So $1,000 in 1982 was not $1,000 in 1966. It wasn't until 1995 that the Dow got back to 1,000 adjusted for the CPI. And I can tell you this, the market even today is much more overvalued by any valuation metric than the market was in 1966. So you can expect a far more severe bear market. And the U.S. financially is in far worse shape as a nation. You know, back in early 1970s, we were still the world's largest creditor nation. Now we're the world's largest debtor nation. We had a large current account surplus. Now we have a large current account deficit. Back in the early 70s, I think the average American, the savings rate was still about 10%. Now it's negative. You know, so people are loaded up with debt. People are, their houses are mortgaged to the hilt. We have a huge national debt. We have an enormous current account liability. So we're going to enter this bear market financially on much shakier ground. So as I said, my prediction for the Nasdaq is it's going to fall to around 500. You know, right now, about 1,700. Got a long way to go down. The Dow Jones still above 10,000. Probably going to fall to between 2,000 and 4,000, but it might go below 2,000.
I've got to ask because, of course, you mentioned the media, and that's really where everyone gets their information. They get it from listening to the experts on the radio or the television news. They read all the magazines that they can and things like this because they're trying to keep up with it. We're hearing that, we had a little recessionary period and it's gone. You're saying it hasn't even happened yet.
The recession has not started yet. The recession, you don't have a recession with consumers going deeper into debt. You pay off debt. You don't have a recession with home sales at record highs, at auto sales at record highs. That's still the boom. It's still the mania. And what's feeding it is foreign demand for U.S. financial assets, which is allowing interest rates in this country to be low and access to credit to be available. But I can tell you now, as we speak, the U.S. dollar has hit a new low for the year, and I think this last bull market in the dollar, which went from 1995 to the present, is over. And the dollar is going to start to fall. And as that fall accelerates, you're going to have significant flows out of U.S. financial assets from all around the world. And that is going to send interest rates through the roof. And when that happens, this whole consumer-driven economy, borrow and spend economy, is going to come tumbling down. And then we're going to have a real recession. And it's not going to be like a recession that people remember from the early 90s. It's going to be very, very severe. And it's going to be accompanied by dramatic increases in the price of consumer goods. So you're going to see a drop in asset prices, meaning stocks and real estate, but significant increases in the price of food, of clothing, of energy, of all these products that Americans consume, because where do these products come from? We import them. And we're importing them with these overvalued dollars. And when foreigners no longer want to send us real goods for pieces of paper, the dollar is going to lose value, and we don't have the manufacturing infrastructure that we used to have. We just can't produce these products ourselves. We have to rely on our ability to import. It's going to take a long time to tear down some of these malls and replace them with factories. You can't do it overnight, and you need capital. So we're in for a lengthy period of very bad economic times. And what I'm trying to do with my clients, and what I've been doing for the last few years, anticipating this, is to try to get people's portfolios prepared for what's going to happen.
Okay, I want to stop you right there because I do want to talk about what people can do to prepare for what you say is coming. Let's go ahead and take a break. Stay with us. Welcome back. You say that we're really living in this imaginary bubble and that soon the bubble will burst. Do you know really what it is that it's going to be or what it's going to take in order to burst that bubble?
As I said, my best guess is it's going to be the dollar going down first, which causes interest rates to rise, which will prick the bubble. It might very well be that interest rates rise on their own, and then the dollar goes down, and then the economy goes down, or a number of things could prick it. But it's a giant bubble in search of a pin, and it's going to find one. But I think the most likely pin is going to be the dollar, and I can see that now, which is why the most important thing that people can do to protect themselves is to diversify out of U.S. dollar-denominated assets, whether that's bonds, stocks, whatever you have. You don't want to be in the dollar. You want to be in other currencies. You can be in the Swiss franc. You can be in the euro. I have a lot of money in Australian dollars, New Zealand dollars. And these are great markets to invest for stocks. We've been buying stocks in Hong Kong, in Singapore, in New Zealand, Australia. And, the reasons we're buying stocks there, first, are valuation. I'm buying stocks at 3, 4, 5, 6 times earnings. Here, your people are paying 30 times earnings, 50 times earnings, 100 times earnings. And in many cases, you don't even know if the earnings are real. But the reason that I know these earnings are real is because the stocks that I'm buying are paying dividends, 7%, 8%, 9%, 10%. I got stocks paying more than 10% in dividends. We just get that just collecting our dividends. So the earnings are real, the balance sheets are good, and these companies are growing their earnings. And, you're in areas of the world, there's going to be a tremendous amount of growth in China. And the companies in Hong Kong or in Singapore are in very good position to benefit from that growth. And they're well-run companies. They got good balance sheets. And, their managers aren't getting rich off of stock options. They're running these companies for the benefits of the shareholders. And you can see that with the dividends. But the most important reason I'm going there is the currency. People need to be out of the U.S. dollar. During the 1970s, if you anticipated the bear market and got out of the dollar, you could have bought Swiss francs in 1972 at 23 cents. And by 1978, they were worth 70 cents. In 1972, you got 360 yen of the dollar. I think by 78, it was down to maybe 150. So the people who got out and got into, foreign currencies or gold bullion. You could have got into gold to protect yourself. In 1972, gold was probably $120 an ounce. It went up to 800. So you could get into non-dollar assets to protect yourself from inflation and the devaluation of the dollar. And I think that this decade is going to be far worse than the 70s because the money that was created during the 1990s and 1980s, the rate at which the Greenspan grew the money supply or the inflation was far more substantial. In the 1960s, The central bank inflated to finance the war in Vietnam, the war on poverty, the Great Society. There was a tremendous expansion of money. Initially, that expansion fed into a stock market bubble that we had in the 60s. When it burst, we had the aftermath, and then we had the inflation move into consumer prices. This time around, we had a bigger growth in the money supply, which spawned an even bigger bubble, and it's going to be a bigger bust, and you're going to see these foreign currencies, gold prices moving up much higher than they did in the 1970s. And and there's still time for people to get out. I mean, there's still plenty of time to get rid of your dollars and to get into sound foreign currencies, and not only stocks. I'm buying government bonds in Australia, government bonds, real estate investment trusts in New Zealand, good income, safety, and you're protected from inflation.
Is this going to be a more widespread problem now because more of us are invested in stocks, either through retirement funds or various other...
Yeah, I mean, a lot of people are going to be devastated by this. I mean, people look at their retirement accounts and think they have wealth there. They don't. There's a number on a piece of paper, but these stocks that they have are not paying dividends. I mean, if you're going to go to retire and you have a stock portfolio, the conventional wisdom is, I'm going to keep my money in stocks, and then when I retire, I'll sell my stocks and buy some bonds to get income. But you've got to ask yourself, sell them to who? Somebody has to be there to buy those stocks from you. That's not going to happen. The stocks that my clients own, when they retire, they never have to sell them because the dividends are providing the return. So you can buy the stock and forget it because you're getting dividends. When you own a stock, you own a percentage of a company. And the way you get compensated is you share in the earnings through the dividends. If you're not getting any dividends, you're just gambling. All you're doing, if you buy a stock without a dividend, you're not investing. You're purely speculating on the price. And if you're trying to invest for retirement, you don't want to speculate. You're not gambling. So people think they have money for retirement. They don't. You know, it's just a giant Ponzi scheme. Just like people who looked at their internet portfolios 3 years ago might have assumed they had a lot of money. They didn't have anything. And the same thing, you can have a portfolio of blue chip stocks. Believe me, these stocks could lose 80% of their value or more by the time you go to retire. So now is the time that people need to really get rid of these shares while there's still people foolish enough to buy them. Because obviously we all can't get out of the market.
Right.
Only a few people can get out because we need the masses to hold the market up. If, 5% of the people try to get out of the market, it would just implode. So only a few people are going to be able to get out. And, you want to be one of those few. You don't want to be one of the people stuck at the end.
And that's the problem. We want to buy low and sell high, as it were, but the problem is we don't know what low is low and we don't know what high is high either.
Things are high. And what people were doing in the mania was buying high and hoping to sell higher. But if you want to buy low, you don't want to buy a stock unless the dividend yield on that stock exceeds the bond rate. Because when you own stock, you're taking risk. You're taking more risk than the bondholder. The bondholder is paid interest. His interest is low because he's not taking a lot of risk. Yeah. When you're a stockholder, you get a dividend. And your dividend needs to be higher than the interest on the bond because you're taking more risk. You're the residual claim on those assets. And a lot of people are going to find out, I think a significant percentage of the Fortune 500 is going to go bankrupt. Balance sheets are a mess. And companies are leveraged to the hilt with a lot of short-term debt. And when interest rates rise, and they will rise, a lot of companies are going to go under. And it doesn't mean they're going to disappear from the scene. It means that the ownership is going to transfer from the people who own the stock to the people who own the bonds. And so people who own equity, they're taking substantial risks, and they don't realize it. And you need to be compensated for that risk, and the way you get compensated is dividends. But Wall Street has brainwashed the public into thinking they don't need dividends.
Okay, I'm going to stop you again. Let's go ahead and take another break. Stay with us. Welcome back. I think it's going to be a hard sell for people to convince them to get out of U.S. interests and into overseas interests, especially today. We've had a lot of, pro-USA things going on. Plus, I think people like to have something tangible, too. I want to invest in something I can see that's, in my neighborhood mall or something like that. How hard of a sell is it to get people to invest overseas?
Well, it's not as difficult as it used to be. Years ago, when I was talking to my clients about the mania in the market in 1998, 99, 2000, it was a lot more difficult for me to convince people that it was a mania and that they needed to get out. But now, as people can see, my predictions, I've never bought an internet stock. In fact, I haven't bought a technology stock since the early 90s. I haven't bought any. I was out, probably by the mid-90s. But my advice to clients, I predicted that 90% of all internet stocks would go bankrupt, that the remaining 10% that didn't go bankrupt would fall by 99.9%. And I think that actually prediction was conservative because it ended up being worse than that. But it was more difficult. But now that people can see these stocks blow up, I mean, you can look at an Enron, for example, with every single major Wall Street firm analyzing these companies with their buy ratings, yet they can let them go to nothing. And people think it's an isolated case. I mean, it's not an isolated case. I mean, just yesterday, 4 major brokerage firms downgraded WorldCom. WorldCom shares have fallen from $60 down to $4 before they go from a strong buy to a hold. I mean, I'd like to ask the analysts, hold what? There's nothing left. But, I mean, WorldCom is where it was 10 years ago. But it's never paid a dime in dividends. No investor who bought WorldCom has benefited from the fact that the stock was at 60, unless, of course, they sold. But, I mean, that's benefiting as a speculator, not an investor. So I think as more and more people are starting to see that Wall Street is conning them, and, hey, if these guys can be so wrong about Enron, so wrong about WorldCom, so wrong about Cisco or any of these companies that were so heavily touted, why can't they be wrong about the whole thing? About what they're saying about the economy, about what they're saying about the market. And they are wrong. All they're trying to do is sell stocks. And Wall Street wants to keep the market high so they can sell more stock, get better fees. They manage money. And their money management fees are based on how much money they're managing. So if they can artificially inflate the value of their money under management, they get bigger fees. It doesn't matter if by the time you need the money, it's gone. They've already made their fees. And these mutual fund managers, the way they're compensated, if you've got your money in mutual funds, your mutual fund manager, he doesn't care if you make any money. All he cares about is, does he outperform his benchmarks? So if the benchmark is loaded up with a bunch of overvalued stocks, he has to buy those stocks in case they keep going up. It doesn't matter if eventually the bubble bursts and they collapse because he's going to lose just like everybody else. I mean, I remember years ago, I think it was Vinnick who was managing the Fidelity Magellan Fund. He made the mistake of thinking the stock market was overvalued. So decided to sell some stocks and buy bonds, and he got fired because he underperformed because the market kept going up. So if you're an investor, you don't care about short-term performance because it means nothing.
Right.
You care about the long-term performance, but your mutual fund manager, he doesn't care about that. So nobody is looking out for your interest. Companies are just trying to jack the share prices up so they can sell. Wall Street wants to keep the price up. If you want to, if you're concerned about your money and your safety, you've got to, take charge of that. And you've got to think for yourself, and you've got to look at things rationally. And you've got to look at these stocks trading at these ridiculous multiples and realize that you can't buy them. You've got to look around the world and find where there is value, where you can invest and get a reasonable return given the risk that you're taking. And you've got to look at, the problems of the United States. And, a lot of people think, getting out of the market, I mean, that's panicking.
Right.
It's not panicking to sell an overvalued market. It's a rational decision that you make. When people are going to panic, and they will panic, is 2 or 3 or 4 years from now, when interest rates are, 12% or 14%, unemployment is 10%, or who knows how high it is, and the market is extremely low, maybe the NASDAQ is 500 or 300, and now people are selling. That's when they'll be panicking.
Right.
And that's when I'll be buying, and my clients will be repatriating their euros and their Swiss francs and their Aussie and New Zealand dollars, and we'll be coming back into the U.S. to prepare for the next bull market that might be 5 or 10 years down the line. But in the meanwhile, we'll be able to buy these stocks that are still around with good dividends at low prices and wait for the next mania where we can sell out to the next group of suckers.
Good. All right. I'm going to stop you again. Let's take one more break. Stay with us.